It's time for the Property Podcast, where every week tens of thousands of property investors, new and experienced, join together to get news, knowledge and laughs at our expense. With me, Rob Bence.
And me, Rob Dix. Join us every Thursday morning for your weekly dose of property ideas and motivation. Then head over to our website at thepropertypodcast.com to keep the conversation going. Now though, let's get started.
Hello and welcome to the Property Podcast. Yes, you've guessed it, I'm Rob B. With me is Rob D. And yes, we are on episode 137. Good morning, Rob. How are you?
Good morning, Rob. I am very well indeed, thank you. It's very dark outside. I think we said last week that we record these episodes at 7 a.m. most of the time, and it's been getting progressively darker while we do these, and it is now pitch black outside. But despite that, it is nice and sunny in our world because we get to talk about property for half an hour, which is never a bad thing. And this week specifically, we're talking about how much money do you need to get started in property? Another one from the How Have We Not Talked About This Yet files. 137 episodes and we're still finding things that we've neglected to mention. So that is what we're going to be talking about. We've also got a slightly troubling news story and a not at all troubling resource of the week. But first, let's have a little bit of a catch-up, shall we? And Rob, you must have a lot of leisure time on your hands because you're doing a lot of hiring at the moment. You must be nothing left for you to do.
My wife said that as well. It's like, oh, well, you don't do this anymore. You don't do that anymore. What are you still doing? I was like, well, there is RMP, Yellow, the Hub. You know, there's plenty to go. So I've got to start looking busy, which is worrying. And I've given all the secrets away last week with yourself, so people are going to be onto me soon. Been hiring at RMP. Mentioned that a few weeks ago. Neil's come in, who's heading up and managing the business, which is fab. Great to have him on board. Very close to hiring a marketing manager now. Very close to hiring another care team member. A few more portfolio managers coming in. So, yeah, lots happening, lots going on. But it's not just RMP. Yellow, we've been super busy hiring this year as well. We've just recruited another local rep. This growth means exciting things are happening and we can do more exciting things.
Yeah, exactly. I've just got this vision of you now sitting at your desk, like sort of stamping holiday request forms or things like that, or refereeing fights over who's used up all the space in the office fridge or something like that. It seems like,
have you got a secret camera?
Yeah, it seems like in all the businesses, things are growing fast, which is a good thing. Speaking about growing fast, the buy-to-let sector growing too fast for some people's liking. And our news story this week is George Osborne handing regulation of buy-to-let mortgages to the Bank of England. So this is a story from The Telegraph. We'll link to it in the show notes. This week's show notes are at thepropertyhub.net/howmuchcash. And the story seems to be, it's another of those things where he's going to announce something, but he's pre-announced the fact that he's going to announce it. So it hasn't happened yet, but the fact that he's going to happen has happened. Following?
You don't want to tell him any of your secrets, would you? You can't hold his water, that, Mr. Osborne.
I know. Exactly. But so what's happened apparently is that the Bank of England last year asked to have control over regulating the buy-to-let mortgage sector. They were meant to be doing a consultation on this, but it seems like instead of doing the consultation, they've just decided to do it anyway. What does this mean? Well, potentially it means that we could see regulation along the lines of what we've seen in the residential sector. So the caps around, like at the moment, lenders kind of impose their own caps on how much they'll lend based on the expected rental income, which is normally like 125% at some kind of pay rate, 5 or 6%. The Bank of England might now impose their own, which might be stricter. There could be other kind of controls. We don't really know, but it just seems to be basically another kind of warning sign, perhaps, of intent here, following on from the budget, that buy-to-let clearly is necessary as a sector. That it's not like he's going to suddenly go crazy and stamp it out completely, but there are concerns about it and he's trying to bring it back under control.
Yeah, well, don't panic too yet and put all your properties up for sale. While there's a vacuum of information, some people will panic and you probably find a lot of interpretation going on over the next few weeks. Let's wait and see what happens. We'll cover it in detail on the Property Podcast, so don't worry. So as soon as there's more information, we'll let you know. But at the moment, don't panic. Let's see what happens. Remember, the government in the past, in the 90s, relinquished control of interest rate settings, and actually that was a good thing. So let's see what happens with buy-to-let. Hopefully it doesn't have too much of an impact, but whatever the impact is, you can be sure we will cover it.
Yes, we will. So let's get on to our topic of the week. How much money do you need to get started in property? And when we introduced this last week, I said that there was actually an answer to this question. It wasn't one of those it depends kind of things. And that is pretty much true. It just so happens that there are multiple answers to this question. There is an amount that gives you access to loads and loads of different options, basically everything you could ever want to do. But if you've got less than that amount of money, there are still options. And those options, of course, come with pros and cons. So what we're going to do is work our way up. So we're going to start with the smallest amount of money that you might have and talk about your options there, and go all the way up from there, talking about what you might be able to do. So the idea is you can think about how much you've got to invest now, find out what your current options are and think, oh, great, I can go away and look into that. Or think, not sure if I like the sound of that. I'm going to keep on saving and wait until I get into the sort of the next bracket that we're going to talk about. So that is the plan. Let's get the ball rolling, shall we, Rob? And the first category we've got is having under 10,000 available.
Yes. Now, little word of warning. This is a rough guide. So please don't email in, oh, well, I've done it for less, or I did it and it cost me a lot more. This is to give you a rough guide. So some of the costs, depending on your strategy, may alter, but this is a good guide to get you started. So under 10K, rent to rent. If you're not familiar with the strategy, the concept is, in its basic form, that you find somebody who owns a property, who may be having trouble letting those properties out, or may be fed up with the hassle of letting those properties out, or just wants a hands-off solution to letting their properties and a guaranteed income. What you can do is persuade them to let you take the property off their hands, manage it for them, give them a guaranteed level of income, and then don't rent it out for more. And maybe you'll rent it out room by room and increase it that way. Sounds interesting. And of course, because you don't physically buy the property, you therefore don't need as much cash. You might need to spend a bit of money marketing to these people to try and find them so you can persuade them to let you carry out this strategy. You may need to spend a little bit of money on training. So it is an option. Should you do this if you've got under 10K? It's fair to say Rob and I aren't big fans of this strategy. For one, you don't own the property and you never will. So there's that big downside, because one of the best things about property investment is the long-term capital growth. And the second thing is it's very work intensive. So this strategy, you'll certainly work for your money and your income. It can be done. Should it be your first choice? Definitely wouldn't be mine. And I don't think it'd be Rob's either, but it's an option. Another option is lease options. We've covered this on the podcast before, and we'll link to it in the show notes. But essentially, you take an option on a property and then let it out while that option goes on. It's a little bit like rent to rent in the fact that you persuade somebody to relinquish control of the day-to-day management of the property, and you hope to make a rental profit during that period. However, again, lease options are a little bit messy, and a lot of the work involved is finding the people who will allow you to put a lease option on their property, and the same with rent to rent. Lease options were more popular when a lot of people were in negative equity, but there's a lot less people about in negative equity now, so the strategy is harder to implement. However, it is an option for people with less cash at the moment because you don't need as much to get started. So an option for those under 10K, the ability to possibly buy the property in the future when you have more funds, but difficult to implement. Another option, of course, is courses. There are lots of courses out there, but many people with under 10,000 are probably going to be attracted to the courses that say, oh, well, if you do this, you'll learn to invest with little or no funds down. And in fact, some of the courses are rent to rent and lease options and others. Not something I'd recommend. If you've got no or low cash, under 10K, spending courses on how to find property strategies with little or no money down probably isn't the best bet. Because if it's that easy to buy properties with little or no money down, why are the people running the courses not just doing that all the time? Because it's probably easier to sell courses than implement the strategy. And that's the hard, cold truth of it. So those type of courses aren't going to fit. You can then go on education courses as well. For example, you've got the Property Hub Summit, which we do once a quarter. However, again, I wouldn't recommend that either, because you'll get a plan and you'll go away with a strategy. And I'd like to think you'll get a lot more value from it than one of those courses. But you're going to need some cash to implement those strategies, which you'll hear about shortly. So I wouldn't recommend that either. So courses, maybe if it's a really cheap one and you want to top up your knowledge, possibly. But as a strategy to get you started, not one I'd implement.
Yeah, you're going to hear a bit of, not negativity, you're going to hear a bit of caution at the start of this episode, and then it's going to become more upbeat as we go on. And there's a reason for that, which links into something I'll talk about at the end. But naturally, when your resources are constrained in terms of cash, then you're going to be having to make compromises. And that's something that we're going to see. Another possible option, if you've got under 10K, is crowd investing. So this is targeted at people who can't afford to buy a whole property. So the idea is, well, if you can't afford a whole property, get 20 people together, you could all own 5% of the property, split the profit that's made after expenses, and when the property is sold, split the capital appreciation from that as well. And of course, the crowd investing platform that's bringing all these people together and managing it will take a cut of both the rent and the capital growth as well. So this is an option. It's not an option that I am massively keen on because you're giving up control. So for a start, you can only invest in the opportunities that the platform has found, and you're then tied into the property without much say over how it is managed. So if it's not being managed particularly well, then there's not a great deal you can do about it. And if you want to get your money out, then you're relying on there being some kind of secondary market where you can sell your share of the property onto someone else. So property is illiquid anyway, because it's not something you can just sell overnight, not if you want to get a decent price for it anyway, but it's even more so with crowd investing. And there is a degree of platform risk as well, of course, because you are dependent on how well the platform performs in terms of sourcing, managing, all that kind of thing. I'm not saying that it's the wrong option for everyone, and I'm not saying that it's never going to be an option. I think it's quite a new sector. And if you are in a position where you have a small amount of money, if you're able to just hold off until you've got more money where you can actually do something that you have more control over, that could be a far better option. And you're going to learn so much more as well. So crowd investing, it is something we've covered before. I'll link to it in the show notes. But I've already moved on to the next option for if you've got under 10K, which is continue to save. It's not an easy thing to do because it's not the most exciting thing. And you get a lot of people, us included, saying the best time to buy property was probably 10 years ago, but if not, then it's now. Don't worry about the fact that the market might dip a bit. It's time in the market is far more important than timing the market. So just get investing now. With all that going around, it is really hard to hold off and just continue to save, especially when you're so excited about getting started in property. But as you'll see as we go along, if you just get a bit more money together, a lot more options open up to you. It means you're going to have fewer constraints. It's going to be easier for you for your first one. And you're just going to learn so much more about investing than you would if you were just kind of passively putting that money into something. So continue to save. It's not the most exciting option. I'm going to struggle to sell my continue to save up course. I think that might fare badly compared to the rent to rent and the lease options courses. But I think it is probably, depending on what you want to do, one of the better options out there.
I'd agree. I'd say the two options you discussed, Rob, crowd investing and continue to save, are probably the strongest of the under 10K options. The crowd investing, if you just want an exposure to property and it's not your main investment vehicle, then it could be an interesting option. As Rob said, though, it's in its infancy at the moment, so beware of that. But continue to save, as dull and as unsexy as that sounds, it's really probably what we feel is the best advice we can give. Moving forwards then, let's say you have saved and now you've moved into that 10 to 25k category. So you've got somewhere between £10,000 to £25,000. Real buy-to-lets open up to you, although they will be cheap buy-to-lets. So you might find yourself being able to purchase a property for around 50k, get some leverage on that and get your first buy-to-let. Fantastic. You've now started your property portfolio. So that definitely is a positive. Taking some action, building your portfolio, getting started, and you'll find you'll do loads and loads of learning by actually just taking that action. That's definitely a plus point. There's loads of positives there. However, not necessarily negatives, but just words of warning. The type of property that you're going to go for, probably if you've done your homework, will give you a nice return, a very good yield, because lower price properties in that sort of price bracket in certain areas tend to yield very well. However, the downside to that is you may have tenants that give you more problems. I'd say properties in that value range have a higher tenant profile risk. Doesn't mean all tenants are bad in that level, not at all, but I'd say the risk is certainly higher. And the other risk you have is capital growth risk. Those type of properties in those type of areas at that price point struggle to get the capital growth compared to some other areas. A prime example, in Liverpool, the core areas, the better areas of Liverpool, which are more expensive, the capital growth is stronger than other areas in Liverpool where you can pick up a terrace for 50k. It kind of makes sense, but it's just something to be aware of, because you can get excited to go, right, I can get started. Doesn't mean no, don't do it, but it's just, be honest with yourself. Don't put the blinkers on and pretend these things aren't there. If you're happy to accept the lower capital growth and you're happy to accept a higher tenant risk, or you feel you've got a good strategy to mitigate that and you want the yield, then go ahead. But just beware, while there's upsides, and there certainly are, there are some negatives there as well.
Yeah, exactly. It's about working out, depending on the area that you're in, and what your overall strategy is in terms of the split between income now and capital growth later, at what point it makes sense for you to invest. Because a minute ago, we were talking about the importance of continuing to save and not rushing in. But of course, you don't want to just save up forever and wait until you can buy the absolute perfect property, or wait till you have the choice of every property in the UK. Because it's far better to just get started and get that learning process. The first property you buy doesn't have to be the greatest deal in the world. So there is a point at which it makes sense. But as Rob quite rightly says, there are notes of caution in there. The point at which a lot more options open up to you is around the 25 to 50k mark. So personally, when I'm asked, I always say that a great amount to start with is at least 30,000. And my reason for saying that is, it's like, well, okay, you put 25,000 down as a 25% deposit. That means you can buy a property up to £100,000, which in most parts of the country will give you options of some properties which will rent very nicely, have some capital appreciation prospects and so on, and give you 5,000 left over for a little bit of a refurb and your fees. So it's very, very rough. And of course, you could do it with more or less. It depends on where in the country. But around that kind of level, a lot more interesting options open up to you. Another option that's in there around this kind of level is flips. Because if you're looking to flip a house, again, with bridging finance, you can probably borrow about sort of 70% or so, have a little bit left over to do a light refurb. You're not going to be able to get into major projects at this kind of stage, but it'll give you enough. So if you can use that 25,000 or so to do a couple of projects a year, you could potentially have doubled that sum of money before too long. And then you're going to have access to the kind of options that we're going to talk about in a minute when you've got more cash. So for me, when you get up to around 25, 30,000, very rough guide, but that's where you can kind of have your pick of almost anything you want to do. You could still, if you wanted, pursue some of the strategies we talked about earlier, but go into them more seriously. So if lease options was really your thing and you're really excited about that and it makes sense for you, well, then you can still do that, but you can invest money into the marketing and do it at a larger scale. It just means that basically around that sum, you can do pretty much whatever you want. But of course, there are some things, Rob, where you need a larger amount of cash still.
Sure. So let's move up another bracket and say you've got over 50,000, and it may be significantly over 50,000. The first option, of course, is carry on what Rob's described doing and build a portfolio of those normal buy-to-let properties, wherever normal is. You could do that, but you can do other stuff as well. Now you open yourself up to being able to invest in the southeast, London in particular, a very popular buy-to-let market. You need more cash, clearly, because the price points are higher. It's interesting. Rob, I was at an evening with many developers actually last night, and it was quite interesting. But I had several conversations with several different developers, and I explained what we do, and I explained why, I particularly look at the north or the Midlands of England and won't touch London. And even though many of them were developing in London as we speak, they said, "Oh, I can see why you're not in London." So it's interesting. I'm not using this. I probably am using this as an excuse to pan London, but just because it was a recent experience for me. And developers who are actually developing there right now said they were, a bit nervous. And actually, nearly all their sales are in the Far East, which is crazy. their marketing efforts, their vast majority of their sales are to investors in Hong Kong, Singapore, still even today. So I obviously put it to them, what would you do if they disappeared? It's not like they're going to be investing forever. And I got a lot of blank looks. But, however, you can...
How to make friends.
Yeah. Yeah. I probably should have eased in a little, but there we go. But using 50k plus, you can invest in the Southeast. Now, I'm going to counteract completely what I've just said. And if you are building a portfolio, over time, you do want exposure in the Southeast. We've discussed this before about balancing your portfolio across different areas. And having some exposure in the Southeast is something you should do. While Rob and I are pretty cautious on the Southeast right now, we both have property there. So it's not like we've always said this, and in the future, we will certainly invest again. But it's very hot right now. But having over 50k allows you to do that. So certainly having it in your portfolio, if you're building a portfolio, not just having one or two investments, then the Southeast, London should be something you can invest in. And with that level of cash, 50k plus, you can do. Refurbs, full refurbs, are now something you can do as well. So you might take on a wreck of a property, a shell, or maybe a full-on development opportunity where you're knocking down a building and building, much more. Having this sort of level of cash now opens these doors up to you. So having over 50k, as you would expect, Rob, we clearly are going to say there's more you can do with the more money. I don't think there's any surprises in this episode. But maybe the lesson should be to think about trying to accumulate more cash so you do have more options. But it isn't just saving. While saving is a really good way of going about this, there are potentially some other options.
Yeah, so if you look into your bank account and you don't like what you see, and all the kind of the 25, 50k numbers are feeling like a long way off, then that's not your only option. You don't have to just keep filling up your piggy bank until you've got that sum of your own money. There are other sources of finance. One of them being joint ventures. It might not always feel like it, but there are a lot of people out there with money. Not necessarily people with multi-millions, but you're going to know more people than you think. You've got a lot of money stashed away and are looking for something to do with it that gives them a better return than they get in the bank. Those people are perfect to joint venture with because there are more people who've got money than there are people who know how to make money out of property. So if you know how to make money out of property, then you can partner up with that person and use their capital and your knowledge. We've talked about joint ventures in the past, and when we did, I said that the reason that I feel a bit funny about joint ventures when they're bandied around is that they're often targeted at newcomers who don't have any cash and don't have any property experience. And in that situation, it's a bit like, well, great, but why would someone lend their money to someone who doesn't necessarily have any more of a clue than they have? Even in that scenario, if you don't have the experience yet, there are still joint ventures in terms of friends and family and that kind of thing. Always put things on a proper legal basis. Always you have proper agreements and think it through carefully, but those options are there. And then, of course, there are other sources of getting your own finance. So you might have equity in your own home, which you can release to invest with. Obviously, not for everyone. Bringing your home into it and kind of having that and having all the risks around that is not going to be something that everyone wants to do. It's not going to be something that everyone's partner is going to want to do. And that links into something we're going to talk about next week. But it is possibly something that's on the table. Then there's personal loans, there's credit cards. There are ways of getting cash together. It should just all be treated with a fair amount of caution because there is risk. If you know what you're doing, you can use that risk and manage it intelligently to get returns. But if you're just going to rush in, remortgage your house, get personal loans, run up the credit card balances and all that kind of thing, and then lose it all because it wasn't a very good deal, not a smart move. But as a podcast listener, I'm sure you are not going to do any of that kind of thing. You're going to make smart decisions. And by doing so, there are all these extra ways of getting that finance in place.
So, what should you do? Plenty of options. If you're in one of those brackets, which strategy should you take? Well, as you'd expect, we're not going to give you an answer because it depends. It depends on you and your situation. Having someone say, oh, you should do rent-to-rent or you should be doing refurbs, if they don't know anything about you, then they're just giving you their biased opinion. What you need to do is think about what you want longer term or even shorter term, but essentially set goals. Say, this is what I want out of property. And then you can look at these strategies and review them. And you'll be able to rule some in and some out based on what you want to achieve. So that'll certainly help you filter a lot out. And then you need to look at your levels of risk, because as we've explained, some of these are more risk intensive than others. And then finally, you need to look at your time commitments, because again, some are more time intensive than others. So by doing the three things I've just described will help you rule in and rule out these strategies. So while some may sound exotic and exciting, they might not be right for you. Or they might be, but you're not going to know until you think about what you want longer term. So that's definitely the action I'd be taking from this, is think about what you want, think about your tolerance to risk, think about the time you can put in, and then start making decisions based on that information.
Yeah, exactly. I mean, you've just touched on something that I've been thinking about a lot recently, because I'm working on a book at the moment. There's a hefty dollop of strategy as part of that book. And in talking about different approaches, I've noticed a sort of a notional triangle, where at each point of the triangle, you've got time frame, you've got capital, and you've got effort. And the more constrained you are with one, the more you're going to have to lean on the others. So if you've got loads of capital, that's brilliant. You can have an income coming in a short time frame, and you won't have to work that hard for it. If your capital is constrained, then you either need to lengthen the time frame, or you need to pursue more effort intensive kind of strategies. And you need to think a lot more carefully about capital preservation as well, because you're not going to want to stop at one property. So you're going to have to make sure that that property you buy gives you the opportunity to get some of that cash back out again. So BMV is a lot more important. So we're really just coming at the same thing from different angles. But as Rob said, the absolute key is to make sure that whatever you do is aligned with your goals. And we'll link in the show notes to our goal setting course, which is completely free and which a lot of people have found useful in getting clarity over what it is that they ultimately want and then developing their strategy accordingly.
Right, so that's how much money you need to get started in property. Hopefully you found that useful. Rob, what we found useful recently, or not found so useful actually, is our choice of conferencing software. What we found useful, though, is our resources of the week, because, backstory, we've used GoToMeeting across our businesses for a while now, and there's always one person who struggles to get in the room, or goes to the wrong room, or has a microphone setup issue, and it just delays things, and it adds this friction that doesn't need to be there. So we've both been looking into alternatives, and we've come across two that we really like. They're really simple to use. They're either free or there's premium packages on them, but to get going, the free is good enough. So if you ever have conferences with people remotely, or, it could be family overseas as well, because Skype's a bit ropey, check these two out. The first one is appear.in. Appear.in. It's super simple. You go on the website, there's a bar to type in your room name. So you type a name, and it might be meeting with mum. Let's say you don't live near your mum, and you type that in. It gives you that URL. You give that to your mum. She types it in, and you can see each other and chat away and share documents and share screens, and all of that is free. Super simple to use, super effective, and it works. That's the main thing. There's lots of different pieces of software out there that do all these wonderful different things, but if you can't get them to work, what's the point? The great thing about appear.in is its simplicity. It just works, and I really like it.
Yeah, I hadn't heard of that until you mentioned it this morning, but it just sounds great. And I should be careful because I'm about to slag off Skype, which we're using right now. So we might get cut off in a sec. But it's just so annoying when you're trying to set up a Skype call with someone. It's like, okay, what's your username? Oh, I can't find you. Oh, I was it's crashed. It's friction, like you said, Rob. And Appear.in seems like a really great option for just cutting through all that and getting to the point of what you actually want to be doing. Another option, which is a good alternative, it's a lot more complex. It's suitable if you're wanting to do meetings with larger numbers of people. It's called Zoom. So rather than just being something really quick and easy like Appear.in, this is something like an alternative to GoToMeeting or something like that, if that's what you use. But we find it a lot more reliable. And in particular, it works really well with large groups of people. So we use this when we do, for example, our summit check-ins. So after each Property Hub Summit, 3 months later, we get on a call with everyone who attended to see how they're getting on with their goals and do a bit of troubleshooting. So you could have upwards of 10 people on there. And often the quality really suffers if you're using other platforms. Zoom just seems to handle it brilliantly. And nobody, whatever device or platform they're using, seems to have any trouble getting on there. So it's just really robust. There is a premium plan for that one. I pay $100 a year for it, so it's pretty inexpensive. But the free plan is really generous. It lets you do everything for a meeting length of up to 45 minutes. So if you want to be a cheapskate about it, and there's nothing wrong with that, you can just get up to 45 minutes, leave, and come back in again. So both of those resources have different use cases, but both of them are well worth looking into. And I think, Rob, it's finally time for us to make the switch, because I've had just about as much as I can deal with of having every meeting starting with 5 minutes of confusion.
Agree. Let's do it, Rob. Let's make that commitment, and we can have a little offline battle about appear.in versus Zoom, which should be fun. What is fun, though, is reading our reviews, Rob.
It is fun, but you always get to hog that fun. Can I do it this week?
You can. Go ahead.
Thank you very much. So this one comes in from Run DMC Gwiggan, who gives us 5 stars. Thank you very much. And he says, after a year or so of procrastination over how to go about investing in property, I came across the Property Podcast after picking up a copy of the excellent book, 100 Property Investment Tips. I've spent the last month with my ears glued to Rob D and Rob B. That sounds painful. Making my way through the entire back catalogue and learning enough to potentially change my life along the way. What makes this podcast, the first one I've ever listened to, so great is it's so clearly focused around giving the listener what they need to succeed. The Robs never blow their own trumpets, are humble, down to earth, and bounce off each other so well. I'm hooked. I don't even notice my commute anymore, and I already feel as though I'm well on my way. Thanks, guys. What a brilliant review. That we love all the reviews we receive. Thank you so much. And that's a great one. If we can just remove the pain from a few people's commutes, I think we're doing something good for the world.
We are. And if you feel the same, we'd love to get a review from you. We're actually the most reviewed and best reviewed podcast in business on iTunes, which is incredible. But there's one podcast that's not too far away from us, and it's got nothing to do with property. So if you like the podcast, we'd like to stay number one. So please do leave us a review. If you like what we do, we'd love you to leave us a review. So please check out iTunes, drop a 5-star, leave a little message, and we'll read out in due course. So yeah, if you could support us, that'd be great.
Okay, so that is us for another week. We better go and do some actual work now, or maybe not. Maybe we should go and have that argument about which video conferencing platform we're going to use. But either way, we will leave you to your day. We'll be back next Tuesday with Ask Rob and Rob. And then next Thursday, we're going to be talking about how to talk to your partner about property. That'll be a really interesting topic. And also next Thursday, it is the meetups across the country. So if you don't have your ticket yet for a meetup to meet other friendly property investors, get over to thepropertyhub.net/meetups and make that happen. So big day next Thursday. And
where are you going to be, Rob?
I'm going to be in Nottingham next week.
So if you're in the Nottingham region, make sure you get along to see the lovely Rob D. And hopefully this doesn't deter people, but I'll be at the Liverpool meetup with Silvio, who heads that one up. So if you're in the Liverpool region, Merseyside, or even close, pop along. If you're in Nottingham or close by, try and get along there. But if you're not near any of those regions, there are plenty more. There's about 13 now, Rob, including international venues. So do check it out. Go to thepropertyhub.net/meetup. And if you are in one of the regions we mentioned, really look forward to seeing you next week.
Yes, indeed. So whether online or offline, we look forward to seeing you very soon. For now, though, bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. Make sure you join our mailing list at thepropertypodcast.com.
And remember, we love 5-star reviews. Rob even loves the modern air miles.